Hello, everyone. My name is Arthur Hayes. I'm the CEO of BitMEX, the Bitcoin Mercantile Exchange. And this is the second lesson in our series of webinars that deals with futures arbitrage trading using Bitcoin US dollar futures. If you didn't get a chance to tune into lesson one, we covered the basics of what a quanto and inverse futures contract is, differences between spot, margin, and futures trading, and then some simple ways to price futures contracts. Now I'm going to start sharing my screen and I'll go to the slide deck. So today in lesson 2, we are going to cover cash and carry arbitrage, which is using our inverse or XBU futures versus spot, calendar spreads, or the rolling of futures contracts between maturities, and very basic volatility arbitrage using our highly leveraged quanto speculative futures contracts. So cash and carry arbitrage is one of the bread and butter strategies of any arbitrage futures trader. And in a nutshell, what you are capturing is the difference between a futures contract and the underlying spot price. Why would futures contract trade at a different price than spot? Well, basically, speculators who believe that Bitcoin will appreciate in the future are willing to borrow US dollars at a higher rate and hope for a price appreciation in the future. And so a futures contract needs to represent that higher US dollar borrowing cost, and that's done by the covered interest rate parity, which we discussed in lesson 1. So here's the basic mechanics. What you'll do is you'll borrow US dollars or US dollars that you have sitting around. You'll buy spot Bitcoin on the reference exchange. You'll sell futures contracts to hedge the US dollar value of Bitcoin. So now you're locked in. You've made a spread. Between when you put on the trade and when it expires, you'll manage your futures margin. And at futures expiry, you'll determine whether or not you want to roll into the next contract. If you want to expire the futures contracts, then you'll let them expire on the expiry date, and then you'll sell Bitcoin at the same time to receive US dollars. And net, you should receive the difference between the futures contract and the spot price. Now, please go to the spreadsheet, the Arbitrage Lesson 2 spreadsheet. And the cash and carry tab. So right now I've mocked up 2 fake futures contracts, a 30-day and a 60-day futures contract. Each contract will be worth 100 US dollars of Bitcoin at any price. This is the inverse futures contract structure that we discussed in lesson 1. And each one has 30 and 60 days to expiry. And here is our time value. So we take the number of days divided by 365. Let's assume that the spot price is $100. And the first thing that we need to compute is our fair price of our futures contract. Now we'll go over here to this tab. And let's assume that our per annum borrowing rate for US dollars is 20%. And Bitcoin has no value in terms of lending or borrowing. Now, using the covered interest rate parity formula, which we discussed in lesson 1, you just do F2, you'll see the formula here. We'll compute the fair price of each futures contract. Now, what you see is there's a difference between the fair price between the 30-day and the 60-day contract. And that's mainly due to the time value of money. You owe more money in 60 days at 20% per annum than you do at 30 days. As a result, the futures price will also trade at a different price in the future. So we have here $105 and $115 as an example. The first calculation that you want to make is what is, if any, the outright premium. So we'll see here for 30 days, we'll earn an outright 3.3%, and for 60 days, 11.34%. Now, if this value is positive, meaning that the futures contract is trading at a premium to the spot price or your fair price based on where you borrow and lend US dollars, you know you have an opportunity to do cash and carry arbitrage. So as we discussed, you'll take your 10,000 US dollars, for an example. You will trade the XBU 30-day contract. assume at a price of $100, you can buy 100 Bitcoin with this 10,000 US dollars. And because each contract is worth 100 US dollars, you will sell 100 futures contracts. Now here we're going to compute the different costs and income that you're going to receive from this arbitrage strategy. First, you have your interest income. And this is basically just looking at the difference between the fair price and spot price. That difference is a cost to you because you're borrowing US dollars. So this is how much you're going to spend in terms of interest for 30 days. The premium income is the difference between the futures contract and the underlying spot price. And this is $500. The difference of which is your profit. Now, this profit will not be immediately realized. You'll have to wait until the futures contract expires to actually realize this $335. So you put on the trade, then you wait 30 days, and now you'll have $335. Now, the next thing that we need to worry about is margin. So I'm going to skip ahead 2 slides to cash and carry margin. Now with futures contracts, BitMEX will require you to post initial and maintenance margin versus your futures contract position. And this is how you obtain your leverage. Now, initial margin is the minimum equity needed to open a position. So you must have this amount of Bitcoin available in your account before you're allowed to place an order. Once an order is executed, then you must maintain the maintenance margin, which is the minimum equity needed to keep the position open. If for whatever reason the position goes against you and your equity drops below the maintenance margin level, then we will have to start liquidating your open position. Liquidation is not preferable. You should not ever let that happen to you. You should always keep a close eye on your margin account to make sure that you always have sufficient money on the exchange. Now let's go through some examples here. Back to the spreadsheet. So right here we have an initial margin of 30% and a maintenance margin of 20%. We entered the position at 105 for our 30-day contract, and let's assume that the price hasn't changed. So what is the entry value in Bitcoin? We just use the value formula for Bitcoin that we discussed in lesson 1. You can see here the formula. And we say it's 95 Bitcoin is what our position is worth at entry and currently. We posted 29 Bitcoin of initial margin, which is the 30%. And now we've put that into our BitMEX account. So now we are fully covered in terms of initial margin levels. And we have 71 Bitcoin left in our personal wallet. Remember, we bought initially 100 Bitcoin with $10,000 that we borrowed. Right now, there's no profit or loss on our futures contract. And so our net BitMEX account is 29 Bitcoin or 30%. Now, we're short futures contracts. Let's assume that the price rises to $115, say. As you see here, we've lost 8 Bitcoin, and now we only have 20 Bitcoin left in our BitMEX account, and our equity percentage has dropped to 23%. You're not in a margin call yet, but we are getting close. So when you see this situation happen, what should you do? Where you hold your personal Bitcoin, you should send a transfer of a few Bitcoin over to your margin account and top it up to make sure that you're never close to reaching that 20% level. So if the price keeps going up and you don't deposit margin, then you will be in a margin call situation, and then your hedge will begin getting liquidated. As your hedge gets liquidated, you are now nakedly long Bitcoin and don't have your short futures hedge. Now, one of the best facets of these inverse contracts when it comes to cash and carry arbitrage is, let's say that you placed all of your Bitcoin in your BitMEX account versus your futures contracts. So now you have 100 Bitcoin in your BitMEX account, nothing in your personal wallet. Now let's assume that the price goes to 1,000. You see here, even if the price goes up and up and up, and you're losing more and more Bitcoin because of the exponential return in terms of the inverse futures contracts. Remember, it's 1 over x is the function that we're talking about. So even if the price goes massively against you, if you fully fund your futures account, you have no risk of ever getting margin called. So if you're comfortable with placing the entire amount of Bitcoin that you have bought for your cash and carry arbitrage on BitMEX, you can go away for 30 days and forget about the trade. And then when it's time to expire, sell your Bitcoin and then remit the US dollars back to yourself. Now, the goal here isn't just to do this for 30 days and that's it. You want to continually earn income by rolling futures contracts, by buying spot and selling futures contracts and continuing to be short futures and long spot. So what that means is you need to roll, or you need to go from the near month contract to the far month contract. Now, at BitMEX, we used to have a contract called calendar spreads. And if you're familiar with traditional finance, you'll call this a calendar spread or you'll call this a roll. And every time it's coming up to expiry, you will trade this specific contract, which will allow you to switch between different maturities. Now, we're intending to bring back the calendar spread shortly to our platform. So I wanted to go through the mechanics of what is the roll and how to think about it. So let's go to the calendar spread section first to describe the mechanics of what a calendar spread is. So assume that you have two contracts open. You have a daily contract and a 2-day contract, let's say, and you hold 5,000 contracts of the daily contract and nothing of the 2-day contract. Now we name the calendar spread by taking the near month and then looking at the last 3 characters of the far month. Given that they have the same underlying, you're just looking at the difference between maturities. So we have the near leg as the 1-day contract, the far leg as the 2-day contract. Now, calendar spreads trade in their own order book, but decompose into the underlying legs. So let's assume that you go onto the XP24H_48H calendar spread order book, and you want to buy 5,000 contracts of this calendar spread. Now, on our platform, we always refer to the far leg. So when I buy 5,000 contracts, I'm buying 5,000 contracts of XPT48H versus selling 5,000 contracts of XPT24H. And as you can see here, this is how this decomposes. Now let's say we go the opposite direction and we want to short roll. Now we are selling 5,000 contracts of the far leg and buying 5,000 contracts of the near leg. Now, our initial position is 5,000 contracts of the near leg or the daily contract. We want to be long 5,000 contracts of a 2-day contract because when the 1-day contract expires, we want to still have a position in futures contracts. So we want to long roll, i.e. we want to go long the far leg. So we want to buy 5,000 contracts. And as you see here, this portfolio changes. Looks like we have an error here. You should be just long the 5,000 contracts of the short leg, and then you have no position left in the daily contract. Now, this is how a calendar roll or calendar spread works on the order book level. Now let's look at how you analyze whether or not you want to roll your contracts at expiry. Let's go back to our cash and carry example. We still have our 60-day contract. It's coming up to expiry. So let's say that we have 10 days left on this one. And 40 days left on the 60-day. Now, continuously as you hold your short futures contracts versus spot, you want to be looking for opportunities to extend your arbitrage strategy. So now that there's 10 days left in the 30-day contract, we want to look to see, should we buy back the 30-day contract and then sell forward the 60-day contract again so that we can earn additional money? So remember here our fair price. We calculated based on our borrowing costs what the fair price of these futures contracts were. Now remember, we said that we look at the roll as back month minus front month. So our fair roll is our 60-day contract fair price minus our 30-day contract fair price. And that's how we get the fair roll. Now we also have the roll price. So the actual market traded price is different from where the fair is trading. And that's giving us the opportunity to extend our cash and carry arbitrage strategy. So now we can compute the actual premium outright. So we have an 8.36% return from starting in 10 days, going out another 30, and then we have this per annum return. So it makes sense for us to buy back the XBU 30-day and then resell the XPT 60-day. Now there are two ways of doing this. Either you can go physically into each order book, the 30-day and the 60-day, and buy sell, or you can trade a calendar spread. Because you are short the 30-day contract, you will be short rolling, i.e. buying back the 30-day contract and selling the 60-day contract. So you would need to trade on the bid of the calendar spread contracts. Okay, now that we've covered cash and carry, let's go on to the basics of volatility arbitrage. Now I'm going to describe a very basic type of volatility arbitrage, and in future lessons I'll go into a more advanced version of this strategy. So the mechanics are, first you calculate again how much does it cost you to borrow US dollars to buy Bitcoin. You want to compute the fair futures price based on covered interest rate parity using your borrowing costs. And then you want to look at the difference between the last price of the futures contract and that fair price. Now, we're not using the XBU or inverse contracts for this strategy. We're using our Quanto contracts, the highly leveraged XPT series. And because of the quadratic exposure in US dollars, you have these contracts will trade at a premium to the covered interest rate parity implied price. And that difference is your US dollar gamma component or convexity. Essentially what you're trading, as I described in lesson 1, is volatility. And in this strategy, we could compute the upper and lower bounds of where the break-even price will be in US dollars for profit and loss purposes. And then we need to make a determination. Do we think the price will settle outside of those bounds by the time of expiry? If not, then we sell futures contracts by spot and then wait. So let's go back to our lesson 2 spreadsheet. Okay, so if any of you remember back in November of 2015, we had the big run up to $500. We have a 24-hour contract that has 100 times leverage. Now, when the spot price was at $500, the daily contract with only 24 hours of expiry left was trading $50 over spot. People were willing to pay 10% above the spot price because they thought the price would rise by more than that in one day. Now, that may or may not have happened, but the smarter trade in terms of a risk-adjusted way was to sell this daily contract and buy spot. So let's describe how you would have affected that strategy. So first of all, again, we have 10,000 US dollars, and we're going to borrow that to buy some Bitcoin. Assume that it costs us 1% per day to borrow this money. And there's no borrowing or lending rate for Bitcoin. Again, for our Quanto series, the futures multiplier is 1,000 Satoshis. And here we have a spot price of $500. Our fair price using the 1% per day borrowing cost. And then our futures price of $550. So we hold 20 Bitcoin at that spot price. And this calculates how many futures contracts we need to sell. So first off, we need to look at using the fair price, how many futures contracts we need to sell. Don't use the spot price and don't use the futures price. You use the fair price, because this includes how much it costs you to borrow those Bitcoins. Now, solving the quadratic equation for a profit and loss of $0, we can come up with the lower and upper bounds of where we start and lose to make money. To lose money actually on this strategy, because we're selling futures contracts and buying spot. And so you can see here the formula for that. Now, this is important. Now you're trading this contract. You see that it's trading at a $50 premium. You compute these numbers and you say, okay, spot has to drop below pretty much $400 or rise above $700 in the next 24 hours for me to lose money. Now, you have to make a determination. Do you think the volatility of Bitcoin is that large that it is likely to drop below or above these two prices in the next 24 hours? And that is why there is a little bit of risk to this strategy. So let's assume that the price settles right at spot. We calculate your $100 of loss based on the interest you had to pay to borrow that money. You made 2 Bitcoin from your futures contracts, so you made a total of $890, or about 9% return on your money. Now, as the price goes down, let's say 450, your total US dollar profit starts going down. In that fashion. And similar on the way up. You start to make less and less money. Now, this strategy is not risk-free. It is not as risk. It is more risky than the cash and carry arbitrage situation. However, because of the high leverage of these daily futures contracts, there are more opportunities to generate these types of returns. Right now, if you look at the futures curve for our 7-day futures contract on BitMEX, you'll see that there's very little premium, if any at all. And that's because the unsecured rate to borrow US dollars is not very high right now. When that rate does rise, you will see the premium of the inverse contracts rise as well, and then cash and carry arbitrage becomes possible. But due to the wild swings of Bitcoin, you get many more opportunities to do volatility arbitrage, especially on the daily contract, as you get intense moments of fear and greed in the market. Now, again, we also have to watch our margin very closely with this strategy. I do not suggest using this strategy with the full amount of leverage that we offer at BitMEX. So the daily contract right now allows for an initial margin of 1% or 100x leverage and a maintenance margin of 0.5% or a maximum of 200x leverage. Now, assume that we enter the futures contract at this price. It doesn't take very much for you to start losing money on your short futures contract hedge. So as a recommendation, I suggest you place well above the 1% initial margin on BitMEX. As you can see here, let's just move the price up $5. You can just move things around like this. But again, always keep a close eye on your margin on the exchange, because what you don't want to happen is you ever come out of hedge during this strategy or any of these cash and carry or basic volatility arbitrage strategies. That is when big losses can occur, because these strategies are meant to generate consistent returns over a long period of time. And if you don't pay attention to your margin, you can have situations where you have a large drawdown and it might invalidate a few days or weeks of hard work that you've been doing putting on these strategies. So if you don't have access to the spreadsheets, the links are in the BitMEX arbitrage lesson 2 slide deck. Now, again, we referred to this XPT pricing spreadsheet in the last lesson. This one has more detail on all the other contracts that we offer at BitMEX, and you can get some more live-looking data out of this. And this you can see the curve, how things are doing on the bid-ask, which contracts look most attractive for these types of strategies. and then your break-even points on the upper and lower levels. Okay, so that concludes lesson 2 for the cash and carry and volatility arbitrage strategies. In lesson 3, we'll go even deeper into basis trading. So that's trading the difference between prices of futures contracts using the same underlying. We'll be focusing exclusively on our XPT or Quanto series because we have a full curve of futures contracts to trade. We'll be looking at curve steepeners, curve flatteners, and how a futures contract rolls down, and different ways that you can earn the differential. These strategies will be a little bit more risky than the 2 strategies that I have previously described, and a little bit more advanced in terms of the number of things that you'll need to look out for when trading. Let me see if there are any questions. Okay, someone wanted me to describe how do you expect such a high interest rate embedded in the futures, 7% a month per more? Okay, why do these futures contracts tend to trade at crazy prices? Someone asked in the chat. Basically, because we offer such high leverage, and a futures contract is really just a method of borrowing and lending US dollars and Bitcoin between 2 parties. Because Bitcoin has very little borrow value, we just concentrate on the US dollar value. So in a sense, as a long holder, I'm buying US dollars for an infinite upside return. Bitcoin can go to infinity. However, on the short side, it can only go to 0. And also with limited liability, i.e. the ability that when my account reaches margin call, I can only lose what I put in. As a long holder, it is beneficial for me to go long futures contracts on Bitcoin because of the asymmetric upside return. And as such, I'm willing to pay a much higher premium over the current spot price because I know there are other people who think just like me. On the short side, that essentially is lending money to the longs to affect their long Bitcoin strategy. Now, when you're lending money with something with an asymmetric upside, it requires much more capital because usually you're going to want to be hedged. So people who sell futures contracts on Bitcoin are usually going to be buying spot as a hedge and earning some sort of carry to compensate them for the capital that they're lending to the longs. And because this is a little bit more advanced strategy, you find that there are less people willing to do arbitrage between Bitcoin and the underlying spot, as opposed to people who are willing to just speculate on the large upside potential of Bitcoin. And because of this demand imbalance and the structural fact of infinite upside, you see our Quanto contracts trade at substantial premiums to spot, especially when the market is dumping and pumping within a span of minutes or hours. People expect that that volatility that is existing could easily take the price 5–10% higher in the next hour or 2-hour candle. So they're more than willing to pay a large premium over spot for a futures contract. So, someone asked insight on to trade the current dump. So one good factor about this basic volatility arbitrage is that you are long volatility. And so when the price, let's say we have a steady rise, we're going up maybe $1 every hour or so, and then we have a massive correction down. That usually the futures contracts will be sticky if the initial move was up. People expect a rebound. It's the buy the dip mentality. And on this buy the dip mentality, you have the futures contract trading much higher than the initial dump in the spot price. And that's an excellent opportunity to sell futures contracts and buy spot because you will get a widening of the premium because of the increased volatility and the way in which the price was trending. Okay, that's all for this week. We will communicate to you guys shortly the details of lesson 3. Thanks everyone for tuning in, and please come to BitMEX and trade our most popular contract, which is our daily contract with 100x leverage. Thank you. Have a good day, good night, good evening.